Ever looked at a massive company's financial report and just felt completely overwhelmed, just pages and pages of numbers?
Oh, definitely.
Or maybe you've tried comparing, say, a small startup to a Fortune 500 giant and thought, how do I even start making sense of these differences? It feels impossible sometimes.
Yeah, the scale difference is huge.
Exactly. How do you cut through all that sheer volume of data to find what truly matters? Well, today, we're diving deep into a really powerful tool for that: common-size financial statements.
A really useful technique.
Our mission here is to unpack what these statements are, why they're so essential for understanding a company's financial health, its strategy, and importantly, how you can spot crucial business insights just by looking at them. But before we dive deeper, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, examples, explanations we're discussing, it's all derived from the comprehensive accounting resources over at farhatlectures.com.
Great stuff over there.
Absolutely. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, definitely visit the website. They've got additional practice questions, video lectures, detailed support, perfect for reinforcing what we talk about today. Big thanks to Professor Farhat for providing this valuable material.
Yeah, definitely. And this isn't just about crunching numbers. It's really about seeing the story, the powerful story the financial data tells.
Story. I like that.
What's really transformative, I think, is how these standardized statements can show you truths that are often hidden by just the raw dollar figures. They make direct comparisons possible where, honestly, they just weren't before.
Okay, so let's unpack this then. At its core, what exactly is a common-size financial statement? What are we talking about here?
Basically, it's a standardized version of a financial statement.
Right.
Think your regular income statement or balance sheet.
Right.
But here, every single line item is shown as a percentage of some base figure. So for an income statement, that base is usually your total revenue or net sales. That becomes 100%.
Okay, sales is 100%.
Exactly. And for a balance sheet, the base is typically total assets. Again, set to 100%. Everything else is a piece of that 100% pie.
So it's like creating a level playing field percentage-wise. But why? Why go through this process? What's the main goal of turning everything into a percentage?
Well, the core purpose is to make comparisons meaningful. It effectively strips away the distorting effect of just sheer size and scale.
So size doesn't matter as much here.
Precisely. It's kind of like a financial equalizer. It lets you compare, a tiny local shop against a multinational giant on the same terms, really showing who's more efficient or maybe where a smaller player is actually outperforming in certain areas.
That sounds incredibly useful. Can you give us a simple example, make it really clear?
Sure, let's imagine two retailers. Retailer A is pretty big, say $10 million in sales. Their cost of goods sold COGS. The direct cost of what they sell is $6 million. So their gross profit is $4 million.
Okay, 10 million sales, 4 million profit.
Right. Now, retailer B is much smaller, only $1 million in sales. Their COGS is $300,000, leaving a gross profit of $700,000.
So at first glance, you'd think retailer A is doing way better, bigger numbers across the board.
Exactly. The absolute dollars make A look dominant. But watch what happens when we convert this to common size. For retailer A, COGS is $6 million divided by $10 million sales. That's 60% of sales. Their gross profit is 40%.
60% cost, 40% profit.
Got it.
Now, retailer B, their COGS is $300,000 divided by $1 million sales. That's only 30% of sales, which means their gross profit is a remarkable 70%.
Wow, okay, that's the aha moment, right. That's where it gets really interesting
All right,
because suddenly retailer B, the little guy, is actually making significantly more profit per dollar of sales, 70 cents on the dollar, versus retailer A's 40 cents. That efficiency is totally hidden if you just look at the raw dollar.
Totally hidden. And that percentage difference immediately tells retailer A, hey, you need to look at your costs or your pricing. Something's going on here compared to your smaller competitor. It flags a major area for investigation. That makes perfect sense. So how do we actually do this calculation? Is it complicated?
Not at all. It's actually quite straightforward. You just take the dollar amount for each line item
Okay.
and divide it by that base figure we talked about. So total assets for the balance sheet or total sales, net sales for the income statement.
Right.
Then multiply by 100 to get your percentage. Simple division.
Can you give a quick balance sheet example?
Yeah, sure. Let's say a company has cash and cash equivalents of $42,000, and their total assets are, let's pick a number, $2,898,875.
Okay.
You just divide the cash, $42,000 by the total assets, $2,898,875. That gives you about 0.0145 multiplied by 100, and you get 1.45%.
So cash is 1.45% of everything the company owns.
Exactly, that's what it means. And just a side note, for the balance sheet, you could also use total liabilities and equity as the base. Since assets, liabilities plus equity, it gives you the same result.
Got it. Okay, so we've seen it's great for comparing different companies, like our retailers. But what else? Beyond just comparing company A to company B, what other powerful insights can we get from these common size statements?
Oh, quite a few, actually. They're really versatile. First off, you can use them for analyzing trends within a single company over time.
Like looking at yourself year after year.
Exactly. Trend analysis. You can see how the company's financial structure or its performance is changing over, say, 3, 5, 10 years. For instance, a small retail chain could compare its own common size income statement over time. Maybe they find their QGS is creeping up from 60% to 65% of sales, while they know their national competitors average around 58%.
Right, that immediately signals a potential problem.
Immediately. It highlights possible inefficiencies in their purchasing. Maybe their pricing strategy isn't keeping up. It's a red flag just from looking at their own numbers over time compared to a benchmark.
It's a powerful internal diagnostic tool, too. What else?
Well, second, there's what's called vertical analysis. This is where you look down a single statement for one period.
Vertically, line by line.
Yeah. Seeing each item as a percentage of the total base gives you insight into the relative weight, the allocation of the company's resources. So on the balance sheet, maybe you see, wow, 30% of our total assets are tied up in inventory.
Okay.
If you know the industry average is only, say, 20%, that 30% immediately raises a question. Do we have too much inventory? Is it becoming obsolete? Are we tying up cash inefficiently? It guides management's focus.
I see. Finding outliers within your own structure. What about costs?
That's the third point. They're excellent for identifying high or, maybe more importantly, rapidly growing expenses. Efficiency and cost control.
Right.
Let's say you're selling general and administrative expenses, SG&A, your overheads like marketing, salaries, rent.
Yeah, the everyday running costs.
Exactly. If those jump from, say, 12% of your sales in year 1 to 18% in year 2, even if your sales also grew, that percentage jump is a warning sign. It suggests those overhead costs are rising faster than your revenue. There might be some operational inefficiency creeping in.
That makes total sense. It really simplifies spotting where costs might be getting out of hand relative to sales. What about bigger picture stuff like strategy or benchmarking?
Absolutely. Fourth point, strategic decision-making and benchmarking. Companies, investors, creditors, even auditors use these extensively. For auditors, it's often a standard first step, a preliminary analytical procedure.
Really? Auditors use this?
Oh, yeah. Convert the numbers to percentages. Look for big jumps, deviations, things that look abnormal compared to last year or industry norms. It helps them focus their testing.
Interesting.
And investors, they might compare two tech firms. Firm A spends 20% of its sales on R&D. Firm B only spends 5%. That tells you something about their commitment to innovation, right? It influences investment decisions.
Huge difference in strategy reflected right there.
Exactly. And the fifth point, which is maybe underestimated, is improved communication.
How so?
They just make complex financial information much easier to grasp for all sorts of stakeholders, even those who aren't, finance whizzes.
Right. Percentages are more intuitive sometimes.
Definitely. I love this example. An MBA class assignment where students are given just the common size balance sheets of several famous companies, say Walmart, Apple, maybe Amazon, a utility company with the names removed.
Okay.
And they have to figure out which company is which just based on the percentages. And they usually can't. You can tell the capital-intensive utility from the inventory-heavy retailer or the R&D-heavy tech firm just by looking at how their assets and liabilities are structured as percentages. It clarifies the business model beautifully.
That's fascinating. So even a startup pitching to investors could use this.
Absolutely. It's a clear way to show here's where our money is going percentage-wise. Here's how we're structured compared to others. Very powerful communication tool.
Okay, the why is definitely powerful. Now let's really dig into it. Put this to the test with some actual numbers. Let's look at a hypothetical year-over-year example, like the one from the Farhat lectures material, and see what specific business implications we can draw out.
Great idea. Let's start with the balance sheet, comparing year 1 to year 2 in common size terms. First thing, cash equivalents went from 1.45% of total assets up to 2.06%.
Okay, a noticeable increase. What's the implication?
Well, it suggests a stronger liquidity position. They have more readily available cash relative to their total size. That means better ability to meet short-term debts, more flexibility maybe for unexpected opportunities or investments. Generally a good sign.
More breathing room, financially speaking.
Exactly. Now, accounts receivable money owed by customers actually went down as a percentage from 17.59% to 14.19%.
Down, is that good or bad?
It could be very good. It might mean they're getting better at collecting money faster. Maybe they tighten their credit policies, less risk of bad debt.
Makes sense?
However, it could also mean their credit sales dropped. Maybe they're selling less on credit overall. So you'd want to look at their sales trends to really understand the story behind that drop. It always requires context.
Right, one number rarely tells the whole story. What about inventory?
Inventory showed a slight increase from 9.72% to 10.06% of total assets. Not a huge jump, but
But still an increase.
right, it might suggest some inefficiency, maybe stockpiling inventory, which means higher carrying costs, risk of obsolescence. But again, context matters. Maybe they're strategically building inventory because they anticipate higher demand, or perhaps some supply chain disruption.
Well, it raises a question, something to monitor.
Precisely. You'd want to look at this alongside their sales forecasts and inventory turnover ratios. Now, fixed assets, things like buildings, machinery, also intangible assets like goodwill, saw a significant jump from 66.77% up to 72.29% of total assets.
Wow, that's a big shift. What does that signal?
It strongly implies the company is investing heavily, expanding operations, upgrading equipment, maybe making acquisitions if goodwill is involved. They're putting more of their resources into long-term productive assets.
Which sounds positive, but needs to pay off, right?
Exactly. The next step is to look at metrics like return on assets, ROI, to see if these big investments are actually generating adequate returns. You don't want assets sitting idle.
Okay, so they're investing more in fixed assets. How did they finance that? What happened on the other side of the balance sheet, liabilities and equity?
Good question. Looking there, total liabilities actually decreased slightly as a percentage of assets from 53.81% down to 51.98%.
Less debt relative to assets.
Right, and consequently, total equity increased from 46.19% up to 48%. So this suggests a bit of deleveraging. They're relying slightly less on debt and perhaps more on equity funding or retained earnings.
What's the benefit of that shift?
It generally lowers financial risk, improves their solvency, makes them look better to lenders, potentially reduces their interest payments, which can help boost net income down the line. It suggests a more stable financial structure.
And you mentioned retained earnings. What happened there?
That also grew significantly. Retained earnings went from 6.03% of total assets up to 9.75%.
That's a big jump, too.
Yeah. It means the company is keeping more of its profits inside the business, reinvesting them rather than paying them all out as dividends. This signals a commitment to funding future growth internally, strengthening their equity base.
Okay, so the balance sheet picture seems to be one of investment, slightly less debt, and retaining profits for growth. Now let's switch to the income statement. What story does that tell? Year one versus year two.
All right, income statement. First, let's look at the gross profit percentage. It actually dipped slightly from 44.71% down to 44.44%.
Down slightly, even if maybe absolute sales were up.
Exactly. Even if total sales dollars increased, the percentage margin slipped a bit. This suggests their cost of goods sold might be increasing just a tiny bit faster than their sales prices. Could be rising input costs, maybe less pricing power in the market. It's something to keep a close eye on. Margins are key.
Definitely. What about operating expenses, like R&D?
Research and development. This one's interesting. It decreased as a percentage of sales from 10.54% down to 7.78%.
Decreased R&D spending relative to sales. What's the implication there?
Well, it could signal a strategic shift. Maybe they're focusing more on cost control right now, less on innovation. What's fascinating here is the potential trade-off.
Right.
Cutting R&D might boost profits in the short term, but if this is a company that relies heavily on innovation, think tech or pharma.
Yeah, their whole future depends on it.
Exactly. Then a sustained decrease in R&D spending as a percentage of sales could raise serious concerns about their long-term growth prospects and competitiveness. Is this a temporary cutback or a worrying trend?
That's a critical question. The percentage flags up. What about other expenses? Depreciation.
Depreciation expense saw a big jump, from 1.47% of sales up to 3.33%.
That seems large. Why would that happen?
Well, it typically indicates that the company has recently bought significant new assets or made substantial capital investments. More assets mean higher depreciation charges spread over time. And this lines up perfectly with what we saw on the balance sheet, right? That big increase in fixed assets.
Ah, connecting the dots. The balance sheet investment is showing up as higher depreciation expense on the income statement.
Precisely. The statements should tell a consistent story. Now, looking at operating income, that's profit before interest and taxes, it actually improved as a percentage of sales from 24.26% up to 24.33%.
So despite the slight dip in gross margin and higher depreciation, their operating profit margin improved.
Yes, which is a very positive sign. It suggests that overall they manage their other operating costs, like SG&A, which we didn't break out here, but implicitly, effectively relative to their revenue growth. It points towards better operating efficiency.
That's good news. How about interest expense? Did that change much with the slight deleveraging?
Interest expense remained pretty stable as a percentage of sales, just slightly down from 3.04% to 2.89%.
Okay, relatively flat.
Yeah, which suggests either their debt levels didn't change drastically in absolute terms, or maybe they managed to refinance some debt at slightly better rates. It's consistent with the balance sheet picture of a stable, slightly improving liability structure, supports sustainability.
Okay, so bringing it all together, what about the bottom line? Net income.
Net income also showed improvement as a percentage of sales, increasing from 16.77% to 17.73%.
So they're keeping more of each sales dollar as final profit.
Exactly. That reflects the improved operating efficiency, managing interest, and overall profitability improvement, even with that slight gross margin pressure. This improved net income percentage ultimately fuels that growth in retained earnings we saw, boosts return on equity, and generally builds investor confidence.
That's a really detailed picture just from comparing percentages year over year.
It really is. But remember, these common size figures are the starting point for analysis. They don't give you all the answers on their own,
Right.
but they absolutely highlight the areas that need deeper investigation, the critical questions an investor, a creditor, or management needs to ask next.
That's a perfect way to frame it. It directs your attention. So let's apply that analyst mindset with a common scenario. Imagine you're looking at a company's common size income statement and you see that their SG&A expenses increased, say, from 8% to 12% of sales over a year. But interestingly, their gross margin stayed exactly the same. What should you as an analyst infer from that specific pattern?
Okay, good scenario. Let's think it through. We know gross margin didn't change. Gross margin is sales minus cost of goods sold.
Right.
So that immediately tells us that rising production costs probably aren't the issue here because that would have likely squeezed the gross margin. So we can probably eliminate rising production costs eroding profitability.
Makes sense.
What else? Well, SG&A expenses went up as a percentage of sales from 8% to 12%. That means those overhead costs are growing faster than the revenue is growing.
Okay.
So you definitely wouldn't say operating efficiency has improved. It looks like the opposite, at least for those overhead costs.
Right. Efficiency seems worse in that area.
So the most direct inference is that overhead expenses are rising faster than revenue. SG&A are overhead expenses, and their increasing percentage clearly shows they're growing disproportionately.
That seems like the logical conclusion.
Exactly. And just to be complete, we could also rule out something like the company's interest obligation has increased because interest expense is completely separate line item, usually below operating income, and isn't reflected in the SG&A percentage.
Got it. So the common size data lets you isolate the issue to overhead cost control.
Precisely. It narrows down the possibilities.
Common size financial statements really are quite transformative when you think about it like this. They let us see past the potentially misleading raw numbers and reveal these critical insights into a company's financial health, its efficiency, its strategic direction, and they make comparisons relevant, truly relevant, regardless of how big or small the companies are.
That's absolutely right. And looking back at our detailed example company, the overall picture was pretty positive, wasn't it? Stronger revenue growth, improved net profitability, seemingly driven by good operational efficiency.
Okay. Mostly positive.
But there were those flags. That rising inventory percentage needs watching. And maybe more importantly, that decline in R&D spending as a percentage of sales. If that company relies on innovation, well, that's an area that warrants much deeper investigation. It highlights potential future risks.
Right. Gives you the crucial questions to ask next.
Exactly. It gives you the questions, not always the final answers, but the right questions.
So, a final thought for everyone listening. Next time you encounter a company's financial report, don't just look at the big dollar figures. Take that extra step. Ask yourself, what hidden stories are the percentages telling me? What might those raw numbers alone be obscuring? And what does that imply about their strategy, their past performance, or maybe even their future potential? It's a whole different lens.